In August 2025, the Trump administration announced a new executive order titled Democratizing Access to Alternative Assets for 401k Investors. The pitch is straightforward. For decades, exclusive, high-yield financial markets were walled off, reserved entirely for billionaires and institutional elites. This policy is supposed to be a massive win for average workers, finally giving them the green light to invest their retirement savings into these lucrative alternative assets. But while this is being sold to the public as a long overdue gift to the middle class, the actual architects of these financial systems are actively sounding the alarm. Former Goldman Sachs CEO Lloyd Blankfein, who navigated the 2008 crash, recently went on record to warn that he smells a crisis, stating that the market is due for a reckoning. The panic is spreading at the highest levels. JP Morgan Chase CEO Jamie Dimon pointed directly to bankruptcies piling up in the lending sector, famously warning that when you see one cockroach, there are always others hiding in the walls. If these alternative markets are such a reliable goldmine, wealthy insiders wouldn't be suddenly lobbying to let average people buy in. That $3 trillion alternative asset market is actually on the verge of implosion, and the smart money is quietly searching for retail investors to hold the bag before the blast hits. To understand why Wall Street is panicking, you have to look at the rules written after the 2008 crash. The government implemented strict regulations designed to stop massive institutions from making the kind of reckless, high-risk corporate loans that nearly destroyed the global economy. But Wall Street found a workaround. A new sector of completely unregulated alternative financial firms stepped into the shadows. By not being traditional banks, they completely bypassed regulations and started handing out those high-risk corporate loans again. This system is known as private credit. This chart shows the massive scale of that regulatory loophole. Since 2008, this unregulated shadow banking sector has ballooned from a niche strategy into a $3 trillion industry. There is a fatal flaw built into these specific loans. They are highly illiquid. In finance, illiquidity simply means that the asset cannot be quickly converted back into cash in an emergency. Once your money goes in, it is incredibly difficult to pull it back out. And we are already seeing the emergency play out. This stock ticker shows the performance of Blue Owl, a massive private credit firm. In early 2026, as bankruptcies began to mount, their stock plummeted by 40% in a single 3-month window. In response to this market panic, some of the largest asset managers on Earth, including BlackRock, are actively blocking their investors from withdrawing their capital. When you trap investors in illiquid assets, you create a psychological feedback loop. People get scared, demand their money, find out they can't have it, and panic further. It is the exact mechanic of a bank run, taking place entirely within an unregulated shadow economy. The trigger for this private credit collapse actually sits thousands of miles away from Wall Street. A massive portion of these shadow loans were handed out to software companies in Silicon Valley. The rapid spread of artificial intelligence technology is aggressively disrupting that specific industry, rendering countless legacy software companies obsolete and driving them into bankruptcy. Compounding the danger, the AI sector itself is inflating an enormous bubble. Massive tech companies with low revenues are recklessly borrowing from each other, taking on trillions in obligations with no clear path to profitability. Currently, just 7 massive tech companies, often called the Magnificent Seven, have market caps larger than the entire stock markets of Europe and China. They are single-handedly propping up the illusion of US GDP growth, masking the reality that roughly 80% of the population has been living in a functional recession. This flowchart maps the exposure. US banks lent $300 billion to unregulated private credit firms. When software companies default, private credit firms go bankrupt, triggering massive defaults on their loans to Wall Street. The contagion travels straight to the top. To add fuel to the fire, the ongoing US-Israeli war on Iran is actively disrupting global supply chains out of the Persian Gulf, triggering historic oil shocks, limiting fertilizer supplies, and guaranteeing a massive resurgence of domestic inflation. The United States is facing a perfect economic storm. An over-leveraged tech bubble is popping, an energy crisis is spiking inflation, and a shadow banking sector is collapsing, all converging simultaneously to threaten the core banking system. Which brings us directly back to the White House executive order. The most sophisticated political donors and institutional investors are fully aware of this impending multi-trillion-dollar convergence. The lobbying behind this policy is direct. Steven Schwartzman, the CEO of Blackstone and a major donor to the Trump campaign, recently watched his firm's stock drop 30%, specifically due to private credit exposure. The phrase democratizing access is purely a marketing term. It is a highly calculated strategy to locate less sophisticated retail investors who can be convinced to buy these toxic, illiquid assets at a premium. By legally opening up the 401k market, Wall Street elites can successfully offload their bad loans, liquidate their own positions, and escape the blast radius before the private credit defaults hit critical mass. In the 2008 financial crisis, Wall Street banks relied on the government to bail them out after the damage was done. This time, they have preemptively rewritten the rules so that your 401ks and pension funds will be the ones absorbing the impact of their gambling.